Hi, my name is Gokul Narayan, and I have with me Dr. Aditya Nain. As all of you know, Aditya is an expert in the field of finance. I have absolutely no clue. No, actually, I should change that line. I do have a little bit of a clue now, but I'm as clueless as most of the average investors in the Indian market are. And just because there's a halo around my head today, that doesn't mean that I am the expert over here. It's just bad lighting. So, Aditya, today I was hoping you've told this idea and concept to me on numerous occasions that, and you've been advising this to me for quite some time, that when the markets dip, don't be afraid, put in money when the markets dip. It sounds counterintuitive to me, coming from a non-financial background. It seems rather weird that when the market's doing badly, get into the market. And I thought we could discuss with our audience why that makes so much of sense, because it took me quite a lot of time to get on board with that, and it's really helped me. I thought we could discuss that today with our audience. What do you say?
Yeah, sounds good, Gokul. So let me first get my glasses on so that I can think
Wow,
properly.
now
Right?
you
No,
sound more authoritative.
I know, right? It's all about the glasses. Okay, so Gokul, that's one of the points that a lot of people struggle with,
Okay.
especially as you said, it's counterintuitive because when the market's dropping, everyone intuitively or I guess instinctively wants to run away. That means they want to pull their money out. So the first thing
Or
that
just
people,
stay, or just freeze in that moment.
yeah,
Just let's not do
freeze.
anything.
No, people want to do stuff. In fact, that's the problem.
Yeah.
And yeah,
Okay.
and doing stuff is not an issue, as you said, if you put more money in. But if you're panic selling and taking it out, then it's a problem. So
Yeah.
think of it this way: the way I like to talk about why you should put money during dips is because it gives you an opportunity to buy, let's say, a stock at a discounted price. So let's say, if HDFC stock is trading at 100 rupees today, it's not, but suppose HDFC stock is trading at 100 today. And then
Okay.
tomorrow, let's say somehow for some reason that falls to 50. So
Okay.
then the value of the stock has fallen 50%. And so that's giving you the opportunity to get in at 50% of a discount to what the stock was trading at the previous day.
Correct. Correct. Correct.
Right.
Yeah.
So if you think of it in terms of forget a stock, suppose you wanted to buy a bike, right? And if that bike was on a 50% discount, I know Gokul that never happens, but suppose a bike was on a 50% discount, then would you not buy it at that discounted price? And
Absolutely. It would make total sense. Yeah.
yeah, so it takes a bit of an adjustment to get used to thinking of stocks in that way. And the
Yeah.
problem people have is they say, but then how do you know that it's a discount? That compared to what, right? What's the full price then? And so, yeah, the way to think about that is, as we were speaking earlier, when you think of a long-term perspective, you invest in the market because you think that the price of the stock's going to increase gradually, right? Year on year.
Yeah. I
So
mean,
then,
that's how the stock markets have been. They've
yeah,
been rising since the time the stock market started off. I mean, it's
yeah. And if we didn't think that it would continue to rise, there's no business of us being in the stock market in any case, right?
absolutely. Yeah.
So we do believe that it'll rise. So from the future value of that stock's perspective, we do, a dip gives you the opportunity to come in at a discount. So
Yeah, so that discounted price thing makes a lot of sense. So it's like why people wait for festive offers to be able to pick up stuff. Like for example, now there's this Amazon big clearance sale, something shenanigans happening because
yeah,
of some I don't know what exactly is the reason for Amazon to have a big clearance whatever sale,
yeah,
but then I'm waiting for it. There are things that I have to buy, and I'm hoping that those things become cheaper. And when you're asking that question, cheaper in comparison to what? Cheaper in comparison to what they were before the sale started off. As simple as that. So
precisely.
now that I'm waiting for it, now when I think of it like that, and I can readjust my thinking to what the original value of the stock was prior to the dip, and then what it is now.
Yeah. Yeah. And in fact, so let's say this HDFC stock was 100 and then it fell to 50.
Yeah.
You're not only getting at a discount of compared to what it was previously, which is 100, but you're getting it at a discount to what it could be the day after, which could be 150 or 200.
Yeah, yeah,
Right?
yeah. Okay, so
So,
so then when it eventually rises, which you're hoping that it will, and you're expecting after having looked at HDFC as a company, you believe that it's going to do well in the future. Its prices are going to rise. You will have the advantage of the dip or the discounted value
yeah.
that that. So, Nen, is it possible that people, when they see the market dipping, they don't realize how much it's going to dip, and therefore they're scared?
Yeah, so that's usually the issue, which is when the markets start to dip, people get scared thinking that it will continue to dip, and that it will continue to fall. And so they feel that they should wait for it to fall even further before getting in. So if the
Hmm.
market falls 10%, or if the stock falls 10%, HDFC, goes from 100 to 90, then people feel, well, it's gone to 90, so it can easily go to
Yeah.
80. And then when it goes to 80, they feel, oh, now it can definitely go to 70. And then once you get to that 70, so that's a 30% drop, right? Once you get to that, then they feel like, oh, now it's just completely wiped out. It's never going to increase again. It'll never get back to its original price. And then they get paralyzed.
And they
But
don't act.
yeah,
Yeah.
but what the sort of market history has shown us is that you can have 30, 40% dips as well, but those are usually lifetime buying opportunities. And those are the
Yeah.
opportunities that people rarely get and you need to seize because, the harder it drops, the quicker it rises as well. Not in all stocks, of course, there are exceptions, but
No,
from a
which was
general
true,
market perspective.
yeah, which was true with respect to what happened in the pandemic also. There was a sudden crash. The markets just tanked. And now it's already much better than what it was. Am I right? It's already doing much better than what it was before the pandemic hit in March.
Yeah, so the Indian market has not yet completely recovered from what it was before March, but it's close
Okay.
to the recovery. But in America, for
So
instance, the
it's
markets,
almost equaled out.
yeah, so it's almost recovered all the losses that it had seen in
And
February.
what kind of dip did we have? Do you have any figures on that?
Yeah, on the Sensex and Nifty, we had close to a 40% dip,
And
plus
that's why you were
minus a
telling me to
couple of
put in
percent.
money, which yeah, that's why you were telling me to put in money, which I unfortunately didn't have at the point of time to put in, so I couldn't. But I'm sure you did ride the wave,
Yeah,
and you're sitting
so
very pretty on
well, I don't know how
a happy
pretty
sum
I'm
of money
sitting.
just because.
Don't know how pretty I'm sitting, but yeah. So I did manage to, but Gokul, that's because not because I was able to time the market, but because I consistently put in money as it was falling, and that's important.
Okay,
And that's
okay,
scary because so when the markets fell 10, 15%, I was putting in some. When it fell 20%, I was putting some 30, 40, so I was putting all the way down. And people get scared because they call it catching falling knives. So do you really want to catch a knife that's falling because it's just going to cut you, right? So for
yeah,
people who don't want to put in money when the market's falling, they say it's like catching falling knives. But then for
wow,
someone who
that's
has a long-term perspective, who can afford to ride out lows, it's good to get in because you never know where the bottom is, as we've discussed a number of times. And since you can never
correct,
predict the bottom, that's really key. Google, people don't get that. You can't predict the future.
correct, correct.
So, in just any way that you can't predict the future, the stock market's just one other example, is that
Hmm.
you don't know where the bottom is, so you need to keep entering in. And
So
so,
the only circumstance that then therefore I can figure out is where not to invest when the market is going down is where you would need the money suddenly.
yeah, absolutely. So
So
we
in
don't
those
want.
circumstances,
Go ahead.
I'm sorry, go ahead.
Okay, so in those circumstances, you don't want to risk that money at all. So,
Correct.
for those of you who are watching this, we have one video on emergency funds. So any money that you need in the short to medium term, it's best for your mental peace and also from like an investing strategy perspective that you don't put that at risk. So just keep that
Correct.
aside. You won't get much out of it. Just put it in a liquid fund or an FD or an ultra short fund or some other type of debt fund, but don't risk it in the stock market.
Yeah. So that's the only circumstance in which you'd say if you need the money on a short-term basis, on an immediate basis, and you don't know how much or how soon you'll require it, don't put it in. But if you're playing the long-term game, that money is a surplus that is waiting to be invested. Uh, but then how do I go about doing it? So for example, Aditya, if I had, for example, 50,000 rupees lying right now,
Right.
and there was a dip that was happening.
Mm.
So I have 50,000 rupees, the market's dipping, but if I enter it at 50 and the market dips more,
Yeah.
then how do I go about investing this in a manner so I can take the maximum amount of advantage of this dip?
Right. So, okay. So Gokul, in your case, you're saying, let's say you got 50,000. and you want to invest that now. Now, the key is that you have all that 50,000, right? It's lying with you. Now, the way
Correct.
that I would do this, there can be differences, but I would give you what I suggest, right? So the way I do it is take some of that 50, let's say 50% of that, so 25,000, and invest that 25,000 as a lump sum.
Okay.
Why? Just so that you can get your feet wet and you're in the market and you're not
Yeah.
waiting for the market to crash because no one knows when it's going to.
Correct.
So
Correct.
whatever the market situation, I personally would invest 25,000, and then from the remaining 25,000 that I have,
Yeah.
I'd set up an SIP where it goes in monthly. So let's say 25,000 spread out over 1 year into the future. Right? So
Okay.
I'm putting in approximately 2,000, just over 2,000 rupees every month. And
Okay.
then within 1 year, I would have invested all of that remaining 25,000. So the
So,
advantage is that I get in today.
okay.
If the market falls, my SIPs are going to help me out because my money will flow in while the market is falling. And if the market rises, I've already got 25,000 that I invested as a lump sum, which will take advantage of that.
So rather than putting in the entire 50,000 in one go, just hedge it out, basically spread it out to give yourself the potential of making the maximum out of it. It is, but I wouldn't you call that a slightly conservative approach?
Yeah, it is. It is, but a lot of people don't have the stomach to put in all 50 in one go if they're first time
Absolutely. I don't
investors.
have it. I don't have the stomach. I'm just saying it sounds conservative,
Mhm.
and conservative is not wrong. I mean, it is just what it is.
Yeah, it's I would say it's the more conservative and prudent approach, especially if you're a first time investor, because it means that you don't freak out, you're able to sleep well at night, and whatever the market conditions are, you'll be able to ride it out. Because suppose, and this happens all the time, suppose you invest that 50,000, let's say it was Jan 2020, and you invested that 50,000. By Feb 2020, that 50,000 would have lost 40% of its value. Right? So now you're
Yeah.
thinking, so that's what, about 30? So now you're
Yeah.
thinking, my 50 is gone to 30. I didn't want to lose money. I wanted to gain money. That's why I put it in the market. So what should I do? If you had put in just 25 and set up an SIP for the remaining 25, you'd be a little more relaxed because you know, okay, so I just lost 40% based on that 25 and I'm getting in at discounted prices, a 40% discount now. So it's okay. It's not all bad.
And because you don't know how much it's going to drop, it will keep systematically investing it. If it drops, great. If it doesn't drop and it rises, it's still great. So
Yeah.
just spreading it over a period of time. So your suggestion generally is, irrespective of whether you've got a lump sum or a little bit to be invested every time, is to spread it out, enter the market at a price, but spread the rest of it out.
Yes.
As a general thumb rule, could we use that?
Yeah, I would be comfortable saying that's a good general thumb rule.
Okay. So let me just see if I've got all of this. Um, if you've got the money, invest it right away. How you invest it is what you need to take a decision on. The question is never whether to invest or not, unless you need that money on a short-term, immediate basis.
Yeah.
So whether to invest or not is never the question. How to invest it is the question. And what you're suggesting for novice investors like me is put in half the money whenever you're deciding to put it in, and then spread the rest over in the form of a systematic investment plan over a period of 6 months or a year or whatever. And how do I go about doing this on my own? Or
Yeah, Gokul,
how do
although
I?
we need to be a little careful about suggesting, just from a compliance perspective. So we don't want people to think that this is personal advice. So if they want
No,
personal
no.
advice,
I'm saying generally.
yeah,
I'm saying generally, if you had to look at the idea of investing in a safe, secure manner, it's like saying wear a helmet while riding a bike.
yes,
I mean,
yes,
it's not that if you wear a helmet, you will not have an accident or you will not die. The possibility of an adverse
mm,
outcome is lessened by that approach. That's just about it.
absolutely perfect.
Okay, but because otherwise it will also, with specific instructions, it will also be depending upon what kind of rider you are and what kind of bike you're riding. Where do you accelerate? Where do you decelerate? I get it. I get that. So, oh yes. Okay. So guys, this is not to be taken literally, and then just don't say Nain and Narayan said take 50%, put it in, and then divide the rest into this, and say, hello, this is what I did. But so it depends. It depends on a lot of permutation combinations. But what we are trying to share with you is that to think of investment in this context makes generic sense instead of being frightened. So, and it is more advice that I have got from Aditya of vis-a-vis my counter-intuitive thought about it, saying that गिर रहा है तो मैं enter नहीं करना चाहूँगा. I mean that it settles me in that regard. All right. All right. So guys, as usual, if you have any questions for us, feel free to let us know. If there are videos, some of you suggested videos that we could. Thank you so much for doing that. Please keep writing into us. You have the email IDs, you have the comment section. Please suggest to us what other videos you'd want to know and hear us speak about. Thank you so much. And Aditya, whatever else you need to tell them.
Thanks a lot, Gokul. That's it. I hope that if you like this video, you like it, hit the like button, and of course, share, subscribe, and hit the bell icon so you can get more of our videos.
And listen to the advice from the man with a halo.